Hi there, I'm Mark Sebastian, founder of OPTIONPIT.com, and this is Riding the Wheel, the Option Pit Method. Reminder, this is for educational purposes only. None of this should be considered investment advice. Options have risk. So here's what you're going to learn. The structure of a covered call, structure of a cash secured put, the perfect covered call and put, the 5 secrets of the great covered call and cash secured put, and how to trade the income wheel. What is a covered call? A covered call is a combination of a long stock position and a short call. The combination creates positions that can produce cash flow, increase investors' margin for error, and help the investor make selling decisions. Always a problem. So let's make a covered call. All right, we're going to use M, Minnesota Mining and Manufacturing. The covered call starts with a long stock position. In this case, we can use M for a price of $97.29. Against that $97.29 call or stock, we sell a call. We get the time premium. We sell a call at $1.63, $1.63. By owning the stock and then selling a call, the combination creates a graph that looks like this. Notice that our break even is now below 96, it's 95.66. So we've lowered the break even. So the net is we collected premium on the trade, which lowers my cost basis on our stock. I limited my upside. As you can see, I limited my upside because if the stock moves above our call strike price, our stock will be called away. And my break even has changed. My break even is now 95.66 or 99.13, 99.13 being 97.5 plus 166. So I now have kind of a range for my break even. I have a top and I have a lower break even. So the low down is the stock price is 97.29. My strike price is 97.5, and my option price is $1.63. So my total return, if I get called away, is going to be $1.84. $1.84 turns out to be 1.8, 1.9%. Right? I'm looking for a minimum 1% on covered calls and short puts, which I'm going to talk about shortly. At $1.84, pretty good. Now, my management mechanics for a covered call. If I do not get the stock called away, buy the call back when it gets super cheap and sell another call. If I can buy the call back for 5 cents or less, I buy it back and then sell another expiration. If the stock runs through the call, right, let the stock get called away, or sell the stock and buy the call, either or. If you have what are called assignment fees, then take a day or two to think about it. Right? Do I still want to have this position? If the answer is yes, then I trade again. Now, what does this look like? The answer is it looks a lot like a covered call. It's not, but it looks a lot like a covered call. Notice how similar these two positions look. All right. On the lower right is the covered call. On the lower left is my short put, the yet unnamed position. That is my short put. The cash secured put has almost all of the same risk characteristics as a covered call. The main difference in terms of risk comes from assignment. Right? A covered call will only get called away when there is a dividend, an option is in the money at expiration, and the seller has stock taken away. Right? A cash secured put on the other side, on the other hand, right? Covered call takes my stock away. Cash secured put will only be assigned to me when that option is in the money at expiration, or an option becomes extremely in the money prior to expiration. I mean, really extremely. Talking 50 points in a, $100 stock. So we're talking like 50% of the value of the stock. And here's the big difference: is the seller has the stock given to them, put to them, as I often say, as opposed to the stock taken away. That's important. So on one, I own the stock at the end after assignment. On the other, I don't own the stock after assignment. The lowdown. The trader is hoping to sell a put after put without being assigned, thus building large amounts of yield. They want to sell puts month and month, week after week, month after month. Okay. If I'm selling a put with 11 days to expire and collecting 46 cents, right? If I'm never put and I collect 46 cents every 11 days in a year, I collect $15.26. That's not bad. $15.26 over $157.50, which is that strike price that I sold, about a 10% yield. That's not bad. Never owning a stock. Management mechanics. The major difference in mechanics is that a cash secured put should be sold slightly out of the money instead of sold slightly, the covered call being sold above the money. So the put sold below the money, out of the money. The call is sold above the strike, out of the money. If a put can be bought less than a nickel, buy the put, sell another one. If the stock gets put to you, you have to be willing to accept delivery, right? And be prepared for a wheel trade, which I'm going to discuss at the end. Duration. At 30 days to expiration, at the money options see a dramatic increase in time decay. Early sales will decay more slowly. In the final week, the call can still have huge portions of decay. So does the put. New traders need to think really hard about when they want to sell. As they become better traders want to sell shorter durations. Greener traders want to sell longer durations. So let's talk about the perfect covered call. In a perfect world, an underlying stock would creep higher, just creeps higher every month, but would not skyrocket higher, right? The trader is able to consistently sell calls at a higher strike price month after month after month. Every month they're building yield on their trade. The stock isn't called away until near the absolute top. And finally, on top of collecting all that premium from the options being sold, the calls being sold, the stock pays a dividend. So the trader is getting call premium, appreciation in the stock price, and a dividend. That's the perfect covered call. The perfect cash secured put is a little different. The underlying stock creeps lower every month, but doesn't tank. The trader is able to sell puts at a lower and lower and lower stock price. Every month, lower strike price. The stock is never put to the trader except for at the very, very bottom. I'll take delivery at the bottom. Most traders would. So how to sell puts and calls in tandem. There's some smart things that can be done to manage the sale of calls and puts. Many involve volatility of the stock and simple decision making. Here are the secrets. The secrets. Now, these aren't real secrets, but I call them the secrets to trading puts and calls. Stock type, right? There's really one major point on everything I've discussed, right? Perfect cash secure put, perfect covered call, duration, mechanics, right? All right. Trade covered calls and cash secured puts in stocks that have low volatility. That is the key. That's it. Low volatility, low beta stocks. So now the 5 secrets. Again, in truth, there are no secrets. There are smart ways to put odds in your favor and not smart ways to put odds against you. I'm going to walk through how to do that. There are real no secrets. Secret 1, only trade in stocks that you're confident won't go down. Notice I didn't say stocks that will go up. There's a big difference, right? If I think a stock's going to go up, I buy a call. There's a big difference between stocks that don't drop versus stocks that don't rally. Stocks that don't drop also don't move higher quickly. That's what makes them great for covered calls. Stocks that don't drop don't fall off quickly. That's what makes them great for puts, cash secured puts. Secret 2, find stocks that are lower volatility. Stocks that have a lower volatility will pay a smaller premium, but won't drop. All right, they won't fall below your break-even point. If the stock does, right, then it should be by a small enough margin so another sale, either put or call, will probably quickly make up for it. Secret 3, buy stocks with a nice dividend stream. Stocks that have a consistent dividend stream have lower volatility. And if I'm assigned on a put and I'm start selling covered calls, I get to have the dividend too. That's great. Secret 4, only trade in stocks that I want to own and have knowledge of. If I don't know anything about healthcare, if I've never looked at it in my life, I should not be trading it. All right? Trade stocks that I understand. And I hate Groupon. I think they're a bad company. I'm not going to trade cash secured puts and covered calls in a cruddy stock. Snapchat. I don't like Snapchat. I don't understand Snapchat. Both boxes checked off. I don't want to trade it. All right, finally, secret 5. If premium is too cheap, then I probably have to be willing to say I don't want to sell an option. If premium is too cheap and you can't find an option that you want to sell, you might want to consider buying. It almost never makes sense to sell options worth 10 cents or less, no matter the price of the stock. And it always makes sense to buy my put or call back for a nickel. Just the way decay works. I always want to cover those things. So now let's talk about the triple income wheel. And this is by far the best way to trade puts and calls in tandem. All right. In the wheel, the trader is using 3 sources to produce income. Source 1, puts. The first rotation of my wheel is I start selling puts. I follow the secrets in selecting a put to sell. All right. I keep selling puts over and over and over again, building up yield. I sell puts at lower and lower strike prices, hopefully. Then hopefully the stock gets put to me. I have to take assignment. I buy the stock at a level that I want to own it. Source 2, the dividend. Once I own the stock, I want to have the dividend. I want to get that dividend to me. Younger traders below 45, make sure that if you take the stock that you immediately get it, put it on a DRIP, a dividend reinvestment program. Cheap way to acquire shares. Older employees and employees of the actual company, right? If you're over 45, take the cash, put it somewhere else. If you work for the company, 1, you probably don't want to be trading in the stock anyway. And 2, take the dividend and put it somewhere else. Source 3, sell calls. In addition to collecting dividends, once a stock is put to the trader should begin selling covered calls. Calls should be sold at a higher and higher strike price. When I'm trading equities, I'm typically looking at about a 30 delta call. But just know that even if I buy and sell the same strike, because of all that premium I took in, I'm going to make money. It's awesome. So the tips. Once a full rotation of the wheel happens, so I sell puts, take delivery, collect dividend, stock rallies, I get the stock called away. Wait a few days. Examine to see if there are better trades. Just because a trade makes money doesn't mean it's the best trade. Common retail mistake. Like a long position, if the trader owns the stock, he or she still needs to have a max loss on long position. If the stock tanks, you have to have a level where you go, I don't want this. And then finally, if your assumptions change, I think this stock is this, low vol, blah, 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 blah. If some of those assumptions change, your theory, the pieces of your theory change, you need to probably get out of the stock. So in summary, high flyers aren't for premium sellers. Turtle stocks are perfect. Learn the secrets and trade the wheel. The Option Pit Weekly Wheel. This is a newsletter we have. It's a great newsletter. I follow stocks that I want to own. I sell puts in them. I then sell puts over and over again until I take delivery. Then I sell covered calls, right? Strategically. Right? I trade them sometimes around earnings, sometimes I don't. I make strategic decisions, right? I'm offering a $7 trial for my weekly wheel for 1 month, right? On top of that, on top of this awesome wheel strategy that I'm going to follow, you also are going to get bi-monthly education. I'm going to do a live webinar. So you get to talk to me twice a month about stuff. I'm going to present things like different types of buy-rated indexes, looking at volatility, analyzing trades. And you get that from me. And then you can ask me questions. Right? I'm also going to release some specific education and ebooks for you as time passes in the weekly wheel subscription. And you can see, you can go to the web page here, optionpit.leadpages.co/dir replay, and you can sign up for the weekly wheel. It's a great newsletter, and I hope to see you here at OptionPit. Got questions? You can email me, info@optionpit.com, or you can call 888-TRADE-01. Have a great rest of your day. Thank you.